In last week's video column, I discussed the importance of understanding how much risk you can comfortably tolerate in your investments. If you're new to investing, or if you aren't sure how much risk you are taking in your current portfolio, it may be helpful to spend a little time to determine your risk tolerance, and you can refer back to that video, and I'll let you know how to start. Another thing that you can do is start by taking a few risk tolerance surveys. A variety of free assessments are available online, and 3 examples are at Vanguard, Schwab, and Morningstar. I like surveys that express your risk in terms of downside volatility, and that is, how much loss could you tolerate? Most will express the downside in terms of how far your portfolio would have to go down over a 12-month period before you would jump out. Unless you only look at your portfolios once a year, which, by the way, I highly recommend, and the research also supports that people that look at their portfolios only once a year earn more, do better than people who look more frequently, for obvious reasons. But if you do that and look just once a year, you most likely won't tend to think of a decline in your investments as being over a 12-month period, because we all anchor on the highest value. That's whatever that highest value is, that's the baseline for us. It's more typical to compare a portfolio's peak value to its lowest point. You may want to ask yourself, how far would the markets need to drop from their highs before you would want to get out, before it's all gone? That's the story that we tell ourselves. It's important to understand that the peak to trough drop, that's the high to low, will usually be much higher than the annual drop. For example, in 2008-2009, the peak to bottom drop in most portfolios was 40% or more, when the 12-month drop was closer to 20%. So, as the Sleep Number bed commercials ask, what's the right number for you? If your 12-month tolerance is a 15% drop, you will need to be in a very conservative portfolio. Perhaps something like an allocation of 25% in equities and 75% in fixed income investments like bonds and CDs. If your tolerance is 25%, a 50-50 allocation may fit. For a tolerance of 35%, maybe a 75-25 allocation will be comfortable. Now, don't take these numbers as gospel. There are many, many variables that will determine what is right for you. I use these simply to give you a context that the less of a drop you can stomach in your portfolio before selling out, the lower your allocation needs to be to equities, and the higher your allocation needs to be to fixed income. If you answer to the question, or if you're going to answer the question of how much risk you are taking in your portfolio is, I have no clue, now is the perfect time to get a clue. Why? We're in the 9th year of a bull market in stocks, the 3rd longest in history. We're 20 months away from it being the longest bull market in history. Another interesting fact is 22 out of the last 23 bear markets bottomed in the first 2 years of the presidential cycle. So if you find yourself taking too much risk in your portfolio, lighten up on equities and increase your allocation to bonds now. Lightening up doesn't mean selling out of equities. Lightening up means maybe just shifting a 70-30 allocation to a 60-40 or a 50-50. Maybe it means adding some asset classes or investment strategies that do well when stocks drop, like managed futures. Sometimes a slight tweak can do a great deal to keep you in the market when the economy looks to be in a death spiral. The time to do that tweaking is before the stock market crashes, which I'm speaking of crash, meaning goes into a bear market, not after. The average bear market lasts, I think, about 9 months, and the average bear market goes down 37%. So they're quick and steep. As the 6 months from, say, September 2008 to 2009 reminded us, bear markets develop very quickly. The important thing is to take action today to become aware of the risk that's in your portfolio and assess whether you need to make a change. Thanks for listening.